Good morning. I'm Patrick Bowens, a realtor for Exit Realty Group here in Fredericksburg, Virginia. Today our podcast is going to be about home financing loans. My guest this morning is Mr. Jim Martino. Good morning, Jim.
Good morning, Patrick. Great to be with you this morning.
Great to have you here.
Thank you.
So would you just tell our guests a little bit about yourself, please?
Sure, thanks for asking. So I am a mortgage banker with the Federal Savings Bank. I started in mortgage banking in 1987, Patrick,
Wow.
31 years ago.
Wow.
Can't believe it's been that long. I lived here in Fredericksburg now for 28 years, and it's just been a joy to be here. I love what I do, and I love helping people in the area of finances.
Great, fantastic. So we're going to talk about home financing.
Yes.
So I remember when I first started out, a couple of investment homes,
Yes.
I had a phone call with the mortgage person, and they said, well, tell us your credit score and what you make. Now, that's not a pre-qual, that's a pre to the pre-qual, correct?
Correct.
Okay.
Yes.
So what are some of the things they look for in a pre-qualification for a loan?
Pre-qualification, I'll distinguish from a pre-approval. Pre-qualification typically is a phone conversation, gathering information from a potential borrower. And normally we would ask for information relating to income, assets, and liabilities. So from an income perspective, we would talk about their salary, any overtime bonus income, for example. If there were more than one borrowers, we would get information on the second borrower as well. And then we would try to get a picture of where their asset situation is to begin to encourage them about specific loan programs that might be available. So we'll ask information about how much they have in the bank, perhaps investments. We may ask about retirement assets as well. And then once we figure those two numbers, we're able to go a little deeper with liabilities. We'll identify if there's any installment loans, such as car loans or student loans. We'll talk a little bit about credit card debt or any other revolving debt, and begin to put a picture together, kind of a puzzle, what that financial piece might look like.
Okay. Great, fantastic. So, also I know tax returns sometimes are required. And why is that, tax return?
They are, and that's a great question. And so now we move more toward the pre-approval. So to distinguish the two, a pre-qualification typically is that phone conversation where we get information. The pre-approval is where we actually begin documenting that information. So there we would ask for things like pay stubs for 30 days, W-2s for 2 years, and typically tax returns for 2 years. Certainly if a person is self-employed, we would look for self-employed tax returns. So if there's 25% ownership in a business, for example, we'll look for the business tax returns. And to your question of why, if a person is not self-employed, we would typically get the tax returns to document the source of income and certify that the information we're using for qualification is truly what's on record with the IRS. One of the background forms that a lender is required to complete is a tax transcript we get from the IRS. And if we have the tax return up front, it's kind of a preliminary view of what that transcript will look like, and it sometimes eliminates a little bit of a headache later of having to go back to a customer and asking for clarification. So those help up front. Certainly if they're self-employed, typically what a lender will do is average income over a 2-year period. So we'll ask for a 2-year history and then a year-to-date profit and loss statement often if any self-employment income is being used.
Okay. So if it is self-employment income,
Yes.
you have to be careful, because if you write off too much and you say, well, I made $70,000, but you have $40,000 that only has
Right.
like $35,000 that you actually made. Is that correct?
Yes, that is correct.
Okay.
That's a common issue that we deal with as lenders. And I often like to say that we as lenders are odd sometimes. We think of things differently than maybe you and I might on our business, for example. So if I earn X dollars, as you said, but I write off a certain amount, the lender's going to use the net income, not the gross income.
Right.
Now there's some add back items that we can add back from the expenses to income, but it is a dilemma that sometimes is posed for that potential customer.